Welcome, everyone. Today, we will examine the COVID-19 economic crisis of 2020, one of the most sudden and severe global economic downturns in modern history. We will review the timeline, the parties involved, what happened, why it happened, how it unfolded, how it ended, and which countries were affected. In December 2019, the first COVID-19 cases were reported in Wuhan, China. By January 2020, the World Health Organization declared a global health emergency. Early signs of stress appeared in global markets as the virus spread beyond China. In February, outbreaks in Europe and the US accelerated. By March, the WHO declared a pandemic. Global stock markets experienced their fastest decline in history. Lockdowns were imposed worldwide and oil prices collapsed. In April and May, unemployment spiked. Global trade slowed dramatically. Central banks cut interest rates and launched emergency lending programs. Governments passed massive stimulus bills to prevent economic collapse. By mid-2020, partial reopenings and news of vaccine development stabilized expectations. Stimulus continued, though uncertainty remained high. By late 2020, vaccine breakthroughs provided hope for recovery. The main parties included national governments such as the US, China, and European Union members. International institutions like the World Health Organization, IMF, and World Bank coordinated responses. Central banks, including the Federal Reserve and the European Central Bank, provided monetary support. The private sector, from corporations to small businesses, was deeply affected. Citizens worldwide bore the brunt of job losses and health risks. The pandemic triggered sudden economic shutdowns. Travel, tourism, retail, and manufacturing activity collapsed. Stock markets lost more than 30% in weeks. Oil prices briefly turned negative. Governments introduced trillions of dollars in stimulus, while central banks slashed interest rates and launched quantitative easing. So, why did the COVID-19 economic crisis of 2020 happen? The crisis happened primarily because of the health emergency. Lockdowns disrupted normal life and halted economic activity. Globalization amplified shocks as supply chains broke down. High levels of debt added to vulnerabilities. Investor panic and consumer fear deepened the downturn. How did the COVID-19 economic crisis of 2020 happen? Mechanically, businesses closed due to lockdowns. Millions lost jobs almost overnight. Stock markets collapsed and volatility hit record highs. Oil demand evaporated, leading to a historic price crash. Supply chains, from manufacturing to food distribution, were disrupted. Central banks intervened with massive liquidity injections. By late 2020, the crisis eased as vaccine announcements restored confidence. Governments continued stimulus programs, and central banks kept monetary policy accommodative. While scars remained, the global economy began to recover in 2021 with mass vaccinations and reopening. Several countries were deeply affected by the crisis. The United States experienced severe unemployment and trillions in fiscal stimulus. China, the initial epicenter, recovered relatively quickly. Europe suffered deep recessions and created a €750 billion recovery fund. Emerging markets were hit by capital outflows and currency depreciation. Virtually every country was affected, making it the sharpest synchronized downturn since the Great Depression. The COVID-19 economic crisis of 2020 demonstrated how a health crisis can trigger a financial and economic shock. It underscored vulnerabilities in supply chains and global finance, but also highlighted the power of unprecedented policy responses. For finance professionals, it remains a key case study in crisis management and resilience. This concludes our discussion about the COVID-19 economic crisis of 2020. See you at the next lecture.